Can't believe. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, Target is about to do the unthinkable, and it indicates the broad economy is far worse than policymakers want us to believe. Plus, Uber just issued a dire warning that indicates demand is coming crashing down. At the same time, we have new evidence which suggests that unemployment claims are about to surge higher. And if you're wondering what we're doing at the Federal Reserve today, well, we're going to show you just how central bankers are about to simultaneously crash the global economy. And we have a sponsor for today's show, Spect-Air. You can find them on the NASDAQ under the symbol SPEC. They're a company where measurement drives changes, and something we think is going to change in a big way is their stock price. We're going to show you how there's been a deep amount of accumulation and it's poised to have a major breakout, which we'll show you could send their stock up by as much as 54%. Stay tuned to the end of the show or check out our pinned comment for more information. Now let's head over to Bloomberg, where we picked today's story up with a headline, as the Bank of England keeps rates unchanged, playing down the talk of cuts. And of course, central bankers all around the world believe that rates not only need to stay high, but maybe even go higher, and that any notion that the global economy is slowing and that perhaps they've overdone it and need to cut rates, well, they don't believe that at all. And we're going to show you that the market believes, as we have suggested, that they are about to cut rates in a major way here in the near future. The central bank's monetary policy committee voted 6-3 to maintain their key rate at 5.25%. Dissenters pushed for another 0.25% increase to choke off what they saw as persistent upward pressure on prices. Now, keep in mind, upward pressure on prices, there's also the supply and demand component. Everyone looks at this from the supply standpoint, saying there just isn't enough supply to meet all the demand. The reality is demand is coming down in a major way, as you're about to see later in today's show. It's much too early to be thinking about rate cuts, Bailey said. Higher interest rates are working and inflation is falling because demand is getting evaporated here, and we need to see inflation continue to fall all the way to our 2% target. And we've held rates unchanged this month, but we'll be watching closely to see if further rate increases are needed. And in order to bring the economy down, I mean, you look around the world and you see these fairly decent GDP numbers, and all of a sudden they're coming down. You see it in Europe. We've got some estimates to show US GDP is coming down. And when you bring demand down, you bring inflation down. The problem is when you've built a massive bubble due to, of course, central banks, easy money policies, you get this inflated bubble and you start to shrink it. And instead of gently letting the air out, well, what happens is you end up popping it. The problem is it's now the global economy that's going to turn into an outright financial crisis all around the world. And the UK bonds led the global rally as bets on rate cuts next year build, so the market doesn't even buy into the narrative of the central bankers. And this is really what's key here, is while central bankers are talking perhaps more rate hikes and persistent inflation, the market is starting to say, no way, you guys have got it wrong. And in fact, you've got it so wrong, you're going to be eager to cut rates far sooner than you even think. The repricing comes after the Bank of England on Thursday held rates unchanged, adding to that a restrictive policy stance would be needed, quote, for an extended period of time to curb Britain's rate of inflation. And that's the issue here, is that central bankers don't understand how the monetary system works. They don't understand inflation, and they think they need to keep it elevated for a long time because somehow we're going to see a repeat of the 1970s, which is highly unlikely. In fact, the global monetary system isn't even the same as it was during the 1970s, but they're so afraid of it that they're going to keep rates elevated, keep yield curves and money curves inverted too long. And what's going to happen is the entire global economy, as we've been making the case, is going to run short of money and all of a sudden one day come crashing down. And traders responded by betting that not only increase in the likelihood of deeper rate cuts eventually, as tighter policy takes a toll on economic activity, as you're about to see later in the show. And one way we know the central bankers are going to cut and cut aggressively is when we look at the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. We've overlaid this against the U.S. federal funds rate. And you can note when banks tighten lending standards and start constricting credit or the amount of new money created in the economy, you see a slowdown in the economy and eventually massive cuts by central bankers, in this case, the Federal Reserve. You see this every time, except now is the only time in history we've really seen an aggressive Federal Reserve hiking into what are already tighter financial conditions. The problem is they just don't want to admit, because they don't seem to realize that financial conditions are tight, and it was just all this excess pandemic money that had to get worked through the system. The problem is it's pretty much gone, as you're about to see. And Powell's tight financial conditions causing them, oddly, to loosen. But did they? Stocks and treasuries rose as the central bank held interest rates steady, and the Fed chair name-checked rising bond yields to helping tighten financial conditions, potentially serving as a substitute for additional interest rate hikes down the road. Now, he believes that higher long-term interest rates lead to tighter financial conditions, when in fact they don't. Because if for some reason long-term yields were actually to rise above short-term and intermediate-term yields, then what would happen is the yield curve would normalize, and banks, lo and behold, would be able to lend profitably, or at least more profitably than they are now, and that would cause them to ease financial conditions. So Powell in this case has got it wrong. He thinks the issue is that higher rates chase away buyers. Well, they tend to only when financial conditions are tight. When the economy is booming and people are making more money and they're feeling prosperous, they don't mind paying a higher interest rate at all. In fact, policy-sensitive 2-year cited by Powell this week duly plummeted after his remarks, along with those on longer-dated bonds, suggesting, well, nobody believes in Powell at all. And that has helped to ease the latest gut-wrenching Treasury rout that has rippled through the global economy, hitting asset prices, squeezing home buyers, and raising the cost of doing business for corporate America and beyond. And why do falling 2-year yields matter? Well, this chart suggests it all because the 2-year yields shown in blue against the federal funds rate, that in red. And what we see in modern times is that when 2-year yields start to fall, it's telling us that the market believes that the Fed is going to start cutting rates, and that's something that not even the central bankers, as you're seeing, they don't believe it. But the market is saying, look, you've done it too much, you've raised rates, you've inverted curves, and all across the board, you're constraining the money creation of the economy, and now we're starting to see signs that the economy is not just slowing down a little bit, but a whole lot. And one problem I think the chairman has at this point is by talking to markets in a supportive way. Stocks rally and bond yields fall, and that's loosening financial conditions, as according to Bill Dudley, the former president of the New York Fed. Well, Bill, you've got it wrong. When interest rates are coming down, it means growth and inflation expectations are falling, and that's exactly what happens right before a massive recession and a financial crisis. Rates start to come down because, Bill, when you understand how the monetary system works, you've constrained the credit creation engine for so long that the only way to get new money created is not higher yields, as many of you central bankers think, but we need actually lower yields to get people to come out and borrow money. And the problem is, even if yields continue to fall, and they will, the banks, well, they still don't want to lend. And that's removing some of the restraint that was creating some of the impetus for not tightening monetary policy further. Bill, couldn't disagree more with your statement there. And while Powell on Wednesday kept open the possibility of fresh hikes in December, traders weighed on the significance of the Federal Open Market Committee's view that tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. All things that we've made cases on this show, that when banks tighten lending standards, what happens? The economy slows, and unemployment claims rise, and inflation comes down. It happens every time. And now as we look to Uber, we see that they've got a dire warning about the economy, suggesting demand, as we made the case, is coming down, as is inflation, just as the central bankers wanted, except the problem is it's going to come crashing down. And that's not what they want at all. As Uber's shipping CEO says, the freight recession is at a new tipping point. Shipper volumes are still down, And carrier rates are still depressed. And so far in Q4, he said Uber's team has observed carriers being more selective on volume, that they take in bids that remain profitable. The key here is shipper volumes are down. And that's going to take us at some point here into our story about Target, because you're not going to believe what they're doing. But when you see shipper volumes down, what does that tell you? Demand is down. That means wholesalers and retailers are not ordering as much stuff. They don't need it because either they have too much already or they don't believe that there's going to be enough demand from consumers. And where does that all back up to? Of course, the manufacturing sector, which we've talked about just showed yesterday, is seeing a decline in new orders and new backlogs, and it all flows into shipping, and it makes perfect sense. As global shipping container rates have dropped by more than half compared to a year ago and are now below the pre-pandemic rates of 2019, again, further validation here that demand is coming down in a major way, because in order to support inflation, what do we need to see in shipper rates? We need them to go higher because everyone's been passing on raises and higher costs. What do actual shippers need? They need more volume so they can actually make more money. They're not seeing it, and that's why we have new evidence now that suggests the U.S. labor market is much closer to breaking apart and seeing mass unemployment than many think is even possible. As U.S. productivity growth by most since 2020 and labor costs decreased. Now, wait a minute. We're being told that labor costs should be rising here and spiraling out of control. This is what central bankers believe is going to drive inflation higher. We've made the case that labor costs are coming down, and as a result, productivity is going up, and that means bad news for the labor market. Productivity or non-farm business employee output per hour rose at a 4.7% annualized rate in the third quarter after climbing 3.6% in the prior period. Now, what this means is that employees are getting more efficient at doing their job. And this happens that when people are on the job longer, they get better at doing it and they're more productive, so they can increase their output per hour. And that has significant impact on inflation. And as you can see in this chart here, we have labor productivity in terms of output per hour, this in blue, against the consumer price index in red, both shown in a year-over-year rate of change. And sure enough, as productivity rises, inflation comes down. You can see that relationship here in the late 90s. You see it here in the early 2000s. Again, productivity rising, inflation coming down. You see it again going into the dot-com bubble or the global financial crisis. You see again, productivity rising, employees getting more output per hour, and that some reason is bringing inflation down, and you see that relationship over and over again. The question you might be asking is, why does that happen? Well, one of the simple reasons is, if you have employees that are more productive, guess what you don't need? You don't need all the unproductive employees. And sure enough, that's what we see when we look at labor productivity in terms of output per hour, still shown in blue on a year-over-year rate of change. And now we overlay the 4-week moving average of initial claims. And what do we know? During periods of rising productivity, you also get rising unemployment claims. And that's a very simple relationship, because employers at that point have hired a bunch of people and they've thinned it down to the most productive employee. They give them the raises and give everyone else the pink slip. And that's one of the reasons why, as you can see here, productivity is rising while unemployment claims have been heading down. But that's going to change in a big way in the near future as employers give up and say, hey, you know what? We don't need you. We've got these other highly productive employees. And that means unit labor costs, or what a business pays employees to produce 1 unit of output, has decreased at a 0.8% rate after climbing 3.2% in the second quarter. And this comes down to some very simple math. You give those productive employees some raises, get rid of the rest, and that means your unit costs head lower. And also means, guess what? Inflation. It goes down too. And here you can see unit labor costs for all workers against the consumer price index. That's shown in red, both on a year-over-year rate of change. And look at the beautiful relationship between the two. You can see when unit labor costs start to go down, well, inflation falls. And it's very simple, because those who are working have less money to pay for goods and services, and that means demand comes down. So you see it's all a demand issue here. Higher productivity, lower costs, less demand, lower inflation, and you can see it every single time. And so that's how we know inflation is going to continue to come down, because employees just don't have the financial spending power they used to have, and they can't command the raises they used to need. And sustained productivity growth helps curb the sting of higher wages and other costs that may otherwise prompt companies to raise their price of goods and services. And this is also why during periods of high inflation, you'll see companies look to automate. They'll look to streamline their operations to reduce the need for employees and keep the most valuable ones, give the valuable ones the raises, get rid of the rest of them. And that's what we see in productivity, because with pay still rising at a robust clip, but not for long, Federal Reserve officials will likely take some comfort in the rapid productivity growth. Of course they are, until the labor market comes falling apart. And that's why now we're leading into our story with Target. They're about to do the unthinkable. But I wanted you to see the context here. You go back to Uber. What do they say? Shipping volumes are down. Demand is down. What do we see? Productivity up, unit labor costs down. That means inflation and demand is coming down. Central bankers are tightening and keeping the financial system tight to the point where there isn't enough money to maintain demand. And so when you put that all in perspective, when you're about to hear from Target, well, it has dire implications for the broad economy. As Target CEO says, shoppers are pulling back, but get this, even on groceries. In an interview with CNBC that aired Thursday, the CEO emphasized that the retailer has posted 7 consecutive quarters of declining sales of discretionary items. And we've said this for so long, that periods of high inflation where total compensation growth lags, you have an issue. You have rent, you have food, and you have energy. And when you see energy prices spike, even if the other two are not moving much, it taps out of discretionary spending. Target now gives us the first evidence this is happening, and as a result, it puts them in a position to do the unthinkable. And what we can see, even apparel, toys, in terms of both dollars and units, are all declining. But even in food and beverage categories over the last few quarters, the number of items they're buying, they've been declining. And what that means is Target is taking a much more conservative approach in planning its inventory this year. And you talk about the unthinkable right now, because what is the factory sector telling us it needs? It needs new orders. And now you're seeing companies like Target. We can only imagine eventually Walmart and other major retailers are going to say, hey, you know what? We're cutting our new order growth down too. That means the layoffs about to impact the manufacturing sector. You think back to yesterday's show, we talked about the ISM. What did the surveys tell us? That layoffs there are starting to begin, and here you can see why. But we're going to lean into those big seasonal moments and play to win when we know the consumer is looking for something that's new, looking for affordability, and looking for that special item for the holiday season. But unfortunately, not many of them are going to be able to afford it, because as we look at this week's initial unemployment claims, what we see is the beginning of a trend of claims heading higher now, up to 217,000. Now, historically, this is low, but keep in mind, it's the trend that matters. The bigger issue here is continuing claims is still now rising, 1.18 million on continuing claims. We know that where continuing claims go, initial claims fall. This is telling us even heading into the holiday season, people that are on unemployment are not able to find work. That is a challenge here. Total claims also up nearest 1.6 million. And so all this tells us is, as we meet and believe that unemployment claims are headed higher, when that happens, it's game over, not just for the U.S. economy, but of course the U.S. role as a consuming nation in the world. That means the entire global economy, it's game over, major recession, followed by a financial crisis. But one thing that we think is going to rise along with the initial claims, that's the stock price of our sponsor for today's show, Spect Air. And keep in mind, you can find them on the NASDAQ under the symbol SPEC. You can find everything in the pinned comment and the description below. Let's check out what's going on with them, because they are where measurement drives changes, and we're going to show you just how we think their stock could move up by as much as 54%. Now, they've got a major product here called AirCore that's going to transform your perspective with real-time emission data. Their patent technology enables molecular level air content testing anytime, anywhere. And why that matters is businesses are being driven to achieve net zero emissions by 2050. Global efforts currently allocate $1.1 trillion US annually to emission reduction. and efforts towards zero net emissions lack clear metrics for measuring progress, setting up Spect Air to be one of the leaders. And one thing we think is going to lead to the upside and be a big benefit for your trading account is their stock. Check this out. Here you can see they haven't been trading too long. We're on the 90-day chart here, and notably what happened, the stock sold down. This is pretty normal when you see a new company hit the market, and look at that major buying came in right around that $1.29 level up into the near $2.50 level. So we have some big players come in and make some big purchases. This drives the stock up to near $3 a share or thereabouts, and now it's pulling back. And I want you to see this big volume here because this is support. So these big players are keeping support under the stock, suggesting the next move is up to the supply zone here around $4.25. And that, my friends, is how you look at a potential 54% gain for Spect Air. Again, on the NASDAQ, on the symbol SPEC. Let's take a further look at what this company is doing, because they believe their technology is going to impact several industries in logistics, energy, agriculture, academics, and even indoor air. And we, of course, we think this is going to have a huge impact on your trading account. As we zoom in now to the 10-day chart, here we can see that volume profile at $2.37, holding there nicely. Again, all that volume adding to the support of this stock. So you see a rally up here into the sell zone. Some sellers came in pushing stocks down into the supply zone. All buyers do then is come in and they push the stock, break through those sellers, and now you're talking a big move higher between these sell zones. Again, potential 54% move higher for Spect Air. Let's take a look at their corporate profile, because they're an industrial technology company that allows its customers to measure, manage, and reduce carbon dioxide equivalent and other greenhouse gas emissions. Spect Air's core offering, AirCore, is a fully integrated hardware, software, and data platform. AirCore is a mass spectrometry research and development, was completed over the course of 15 years at the Massachusetts Institute of Technology, and their business model delivers a win-win-win for Spect Air, their customers, and society as a whole, and that means for their stock as well. Let's take a look at the 2-day chart. Here we can see momentum building off of oversold territory as the RSI rises and the MACD moving up, bounce across into positive territory. It's got a nice positive cross deep in oversold territory. That's what we want. You can see at $3, that's where the battleground is at, where buyers and sellers are duking it out. You get past that $3 here, and guess what? You're talking a breakout over $3.25, upwards of $4.25 a share. Again, check them out on the NASDAQ, on the symbol SPEC. Again, with all of our sponsors, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.